Morning, you too. Happy Saturday to all. Can't go wrong with this gas station coffee, let me tell you. I wanted to get on here on this beautiful Saturday and talk to all of you guys that have reached out to me wanting to learn more about this leadership position. And most of you guys are current agency owners, or you're wanting to get to a point where you can start building an agency, but you realize that building an agency is a business, and every business requires capital, resources in order to get it done. It's not just recruiting people. And one of the things that I talk about is we provide financing, lead financing to our leaders. And today, what I wanted to do is break that down exactly how our lead financing works, because I also said that we don't do a formal credit check. We're not going to require the same type of requirements that you would need when you go down to the bank to get a business loan. We look at different other factors. But what's the catch, right? How is it that we can provide financing to you, your agents, and we're not going to check the credit? Well, again, I'm going to explain it to you guys how this all breaks down. But before I do, I'm going to share with you guys some information. Got some visuals here for you guys. Now, as you guys are aware, I am currently hiring leaders to join my distribution channel. I'm very eager in growing my Royal Neighbors block of business, Senior Life, Polish, Illinois Mutual, just to name a few. But I need good leaders to help me train others on how to do this. But again, financing. If you're looking for it, listen in. So I've been providing lead financing for many, many years. It's a really good way to build an agency at a fast pace, because you're giving agents leads, you're putting them to work, and they're, going out there and making it happen. In a perfect world, lead financing makes sense, where I finance you the leads, you go out there and write business. When you make some commissions, I get paid back, correct? But I want you to take a look at this letter from a collection agency from when I sent over 31 files for collections. Okay, these are agents that needed lead financing, wanted advances on their commissions, etc. And it says, "Dear Lauro, this is to inform you that the 31 files that you've sent over have been found to be uncollectible on arrival. Most were too old and way past the statute of limitations. Those that were not past the statute of limitations were found to be too small for a lawsuit, $1,000, $2,000 range. Typically, what people are financing in leads. Also, please be aware that AGA only handles commercial accounts. I do understand that these debtors are insurance agents, but we do not find that any of them were registered as businesses with their state secretary's office, so their status as commercial accounts is dubious." So as you guys can see here, this is 31 files that I sent over to one collection agency before I started learning a way to go about this. But first of all, let's talk about what lead financing really comes down to. What is it? Well, if I team up with you and you have no money for leads, okay? Zero. And a lot of you guys that are leaders don't have money to invest in your leads, so financing makes sense. So I go ahead and I create a threshold of $1,000 per one of your agents. So if you got 30 agents, that's pretty much $30,000 of credit that I've extended to you and your agency in financing. But the way the financing work with leads is that I'm either going to bill you 100% for the leads on the next commission check that you get. So if the lead balance was $1,000 and your commission check was 500, that 500 is used to pay back this lead balance. I've also made arrangements with other groups where they pay me once a month. But in a perfect world, you write business, it pays itself back, or you cut me a check at the end of the month in a perfect world, correct? But we're not in a perfect world. And this is one of the biggest risks of building an agency, developing agencies, agents, co-signing for these agents, for leads, not to mention commission advances, which is also a form of financing from the carrier. So what do? Well, first of all, let's break down how it is that chargebacks happen, first of all. And then on top of this, we're going to talk about leads, because it's a cost. We're financing. So in this example, here's a $60 policy. A year, they're going to pay $720 to the carrier. And I'm using an entry-level contract of 60% to factor in the 30-40% of people that are going to be guaranteed issue, graded. And for those of you guys that don't know why, those type of products that accommodate those type of health conditions are going to pay a lower commission. So when you average out the lower commission products with the higher commission products that typically associates with people in good health, then we come out with a solid 60%. Out of that $720, 60% of that, your first year, is your commission, is your compensation. So that's $432. Now the carrier is going to advance you 75% out of those $432, which would mean that within the next 24 to 48 hours, you have $324 in your bank. But let me break down what this advance is, because we're talking about financing. We're talking about lead financing as well as commissions. Well, your commission is 60% of what they pay. So 75% advance means that the company is going to advance you those 9 months of commissions against that first year contract. It really is a loan, because the client made one payment of $60. One. And the carrier is going to loan you 9 months advance against that policy. So what they're betting is that this policy is going to be here forever. For the first year, they expect to collect $720. So when you take $324, what they advance you in your bank now, that comes out to $36 a month. And if you were to take that $60 policy and multiply it times 60%, that would be $36 a month. So if you didn't have the advances or you couldn't qualify because of an issue in your credit, then you would be able to work and sell, but you wouldn't receive any of the advances. Instead, they would pay you every time the customer pays, they would pay you $36. So how do you build a chargeback balance? Here are a couple examples. Customer one pays for 6 months and stops paying, cancels, whatever. Your chargeback is $108 because remember, they advanced you $324, which meant 9 months. Customer only paid for 6 months. You owe the carrier 3 months, which is $108. If your second customer paid in 8 months, your chargeback's only 1 month. If your customer number 3 paid in only 1 month, so 1 month in, they made the first payment, then they canceled to stop paying, then you owe $288, 8 months worth of that advance. Now multiply this, ladies and gentlemen, to a percentage every single month, because there's no perfect business. And I always tell my agents that if they follow our system, to expect no more than 20% of your business to fall off the books. As a company and an agency, I'm happy to say that for years, our persistency, 13th month persistency, has been over 85%, 100% telephonically. But right here, let's say, for example, you came and worked for my company and you wrote 10 applications, and next month you quit on me, and half of those didn't make a secondary payment. Well, then all the advances that you received that first month, the second month, half of those are now in chargeback mode, meaning you owe them that money. But hey, agents are smart, right? They just leave, they go to another company, they talk shit about their current manager and go somewhere else. Get signed up with another company, and they forget about this. They forget about these chargebacks. They ignore the notices of the carrier. Hey, Johnny, by the way, you have a balance here at the insurance company of $500. Can you send a payment? What next? Well, the carrier will put you on a vector where you're just flagged every time someone contracts you. They're going to flag you, and chances are they're not going to work with you. But there's a lot of companies that work with people even if they owe money. But how does that tie in with us? Well, let me show you. When we build an agent and we develop an agent, we're going to give them advances just like what you see here. So this is one form of financing that we provide. But again, if you're an agent looking for lead financing support to build your company, now on top of this, we're going to help you with leads. Now, regardless if you decide to pay us out of your paycheck, what we can do, like with companies like Senior Life, or you cut us a check once a month, but in the moment that you back out or don't pay, this is our resolution. And that is, we have everyone sign a 1099-C. And for those of you guys that don't know what that is, a 1099-C is a cancellation of debt. Okay, and I want to read this to you guys so you guys understand this, because a lot of people in the insurance business aren't talking about this, especially if they're encouraging you to build a team, right? Number one, issuance of Internal Revenue Service Form 1099. Pursuant to the contractor agreement, the contractor is responsible for any unearned commissionable premiums. Again, unearned commissionable premiums. These 3 months, 1 month, 8 months, those are the months that were not earned. So that would apply to as earned commissionable premiums, and payment of unearned commissionable premiums to the contractor are a loan to the contractor from the company and all insurance agents that are upline to the contractor for the applicable carrier. You guys notice that? So you get day one vesting. So everything that you do from day one is yours, but listen carefully to how this works. Until such unearned commissionable premiums become fully earned, in the event there is any company paid premium that is not immediately reimbursed or repaid by the contractor, the company or any or more of its direct or indirect subsidiaries that pays or otherwise becomes responsible for satisfying the company paid premium, and any insurance agent that is or was upline to the contractor and that pays or otherwise becomes responsible for satisfying the company paid premium may, with or without notice to the contractor, issue to the contractor a 1099-C reflecting income to the contractor in the amount of such unearned commissionable premium for which the issuing party becomes responsible for satisfying. The forgiving remedy shall be cumulative and exclusive and shall be in addition to any other remedy the aggrieved party may have, including, without limitation, the right to recover unearned commissionable premiums and all related damages and attorney fees. So, ladies and gentlemen, what this means is that if you need financing, you want advances, then you would have to sign off on this 1099-C in order to come and work with my group and my partners. Simple. We're not going to do no credit check. Again, that's not how we're checking. We're taking a few different points, ideas, and that's how we're coming up with your credit worthiness. But at the end of the day, when you are day one vested, what that means is every single policy that you write is yours. So just like you're responsible for the liabilities and the financing, you're also the owner of all the income that your business will generate. So again, I'm not going to take away your renewals. You're not going to forfeit them. If you don't pay back your chargebacks, your financing, what we will do is we'll send you the proper notices. We'll give you an opportunity to pay. But then eventually, we're just going to submit the 1099-C and take the tax deductible as a company. But for you, it's going to show up as income, where you're going to have to report it as income, pay taxes on income. And hey, we've been there, we've done that. And I just shared with you guys the collection letter. If you're a leader, this is something that you should really consider, especially if you're building. But if you're building and you're okay with these terms of engagement, give me a call. I'm looking to build my distribution channel. I have great carrier relationships. We have a powerhouse of leads, ranging from live transfers, internet inbound leads. And if this is your first time here to my channel, check out some of my other content, and you'll see what I'm talking about. But I'm looking to grow my channel. I'm looking to sell thousands of applications. And one of the ways that we're doing it too is helping others get their life insurance license. That is the best talent pool to meet the demand that we're facing. So if you're also considering getting your license, if you go in the content section here below, you'll see a link that'll take you directly to the website, Excel Solutions. And if you use my virtual code of VirtualFE, it's going to give you a 75% discount on the courses, and you'll be on your journey to start and selling insurance. So with that said, to all my leaders out there, I hope this helped you understand exactly how this works, how our financing works. If I can help you, call me. I'll be more happy to talk to you more about this. Now, if I look into your background, you got a bunch of vectors with other carriers. That's one thing we look for. Because I'll tell you one thing. When you hire a new agent, right, or an agent calls you up and talks shit about his prior manager, and then you look at his background, he has a bunch of vectors, he hasn't paid him off, hasn't made an attempt to pay him off, or a dispute, that's not a good sign. Chances are they're going to do the same to you. Or you bring a new person, and immediately, right off the top, you start seeing a bunch of applications hit the leaderboard. Some new managers might be excited to see that, but the veterans understand that that's a big red flag. Because what happens is this: people take advantage of these financing privileges, and they roll business. So if I'm working at company A, then I go to company B, and I'm talking shit about company A, now that I'm at company B, and I start influencing my clients to roll over to company B without doing all the proper replacement policy forms, and then they don't go back and repay their chargebacks at the company they were at. That happens all the time. I've seen managers had chargebacks of 20, 30, 40, 50,000, couldn't pay it off. They did not have enough collateral with the carrier to pay it off. It's sad. And a lot of you guys don't even talk about this shit, but it's true. So I hope this helped you. I'm serious about growing. If you'd like to meet or get some of my referrals on the carrier side, call me. I'll introduce you, because some of these guys are looking to buy up some insurance agencies, let me tell you, and they got some money. So with that said, you guys have a wonderful weekend, and see you guys at the top. Peace.